Tanvee Gupta Jain joins us on the show right now, Chief India Economist at UBS Securities. Tanvee, hi, great to have you on ET Now today. Did it come as a surprise, Tanvee, that the CPI inflation has come in at the highest level this year?
I would say yes, a part of it was expected. We were actually at 5.24, but clearly, and consensus was 5.1, but the CPI came even 40 basis point above consensus. So yes, partly it's a surprise, but I would say it is largely on account of adverse base effect, which kind of RBI also highlighted as a part of the MPC policy review. Plus, the sequential increase in food price momentum, whether it is because of weather-related disruption or seasonal factors, was quite elevated.
Even though the CPI numbers are not that great, last week in the MPC, the governor, whom I'm sure had a sense of which way inflation would move, was not sounding worried. Which clearly means that even though inflation print has 5% plus, Reserve Bank of India certainly feels that it is headed lower.
So if I look at inflation dynamics and how they will shape up, going forward, I would say for the month of October, because we are tracking the retail prices of vegetables, and I have data available till date, and it is suggesting that the vegetable prices, especially tomatoes, potatoes, onions, could have remained elevated. So which means that your October data print could actually be closer to 5%. Obviously, I only have the data for the first 2 weeks. I still have to see what the next 2 weeks data is going to be. But if I look at data beyond October, that is from November to March, I would say inflation is going to soften significantly. I mean, we have seen the monsoons have been pretty good this year. Summer crop sowing has progressed well. The hope is that the winter crop sowing will be good. You will start to see from November onwards summer crop arrival in the market. And I think that is what the RBI governor could be highlighting. Even if you look at the MPC, the tone of the tone in the policy statement, it was a pretty cautious. I mean, they changed the stance to neutral, but the tone was not very dovish. But clearly, I think barring the near-term peak, we also expect inflation to soften significantly between November and March.
Right. So, Tanvee, should we not give up hopes of some rate easing from the MPC then?
So we actually have a 75 basis point easing in our base case. Now the question is the timing of this rate cut cycle, because we do realize that the global monetary easing cycle has begun. I mean, US economics team, at least at UBS, is still expecting Fed to cut rates further by 25 basis point in the next two policies in 2024. So what matters for the RBI is that how is the RBI going to react, because they've already changed the stance to neutral. So I would say there are two data points that RBI will consider before the December policy review. One is the GDP print, which will be out for the September quarter, which I think that at least the lead indicators or the high frequency data that we track, it's clearly showing that after a weak June quarter, we might actually see that the growth would have remained sluggish even in the September quarter as well. And the second could be the October inflation print. So till the time I don't see October inflation print significantly below 5%, it would be hard for the RBI to go ahead with a rate cut in the December policy. So I would say we have 75 basis point rate cut in our base case, but the timing, whether the cycle starts from December of this year or Feb of next year, is completely a function of domestic growth inflation dynamics.
WPI data, and the WPI data consistently has been low. So while we may talk about CPI and make a view on retail inflation, the problem I feel is wholesale. Wholesale pricing is not coming back, which clearly means that the economy had started slowing down.
I would say the wholesale pricing not coming out is also a function of what is the weight of imported commodities in your inflation index. So, for example, in the case of CPI, the share of imported global commodities is only is around 20 to 24%. In the case of WPI, it's more than 50%. So clearly, if the international global commodity prices are muted, you will see the gap between WPI and CPI continuing to remain. At the same time, which is very interesting, and the point which you highlighted, that if the WPI is not going up, it is basically showing what is the state of the economy. I think a better reflection of that will be a core CPI inflation, which so far has been muted. I mean, averaging around 3.3%, historically has been somewhere around 4.5%. And that is clearly indicating that the mass market consumption demand in the economy is still muted. So I would say more than WPI, I would focus on the core CPI, and that continues to remain muted. It has clearly bottomed out. We do expect some pickup as rural demand picks up, hopefully, and there is a festive season demand picking up. We should see in the December quarter, but I don't see it a significant pickup even in the core CPI inflation over the months ahead.
View that the government capex is slowing down. It could be because of election, it could be because of weather, it could be out of compulsion. But are we in for a huge disappointment on the government capex for the full year?
So I think let's look at both the central as well as the state government capex. If I look at the central government capex, you're very rightly pointed out that the central government capex FITD is down. I mean, we would have expected that after the election spending, election-related slowdown in the June quarter, there should have been a pickup in the September quarter. But July we saw a pickup. August again there is a decline. And when I look at the sectors, it's roads, railways, it's defense. Even there is a lower allocation in terms of interest-free loan to states. Even if I assume that the government will be able to, increase the capex spending in the remaining 7 months, the central government capex alone needs to go up by 40%, which I think will be challenging. If I look at even the state governments, I mean FITD, the state government capex is also down, which is again a concern. We get data of 23 states, and that is showing me around a 9% fall in the state capex in the first 5 months. When I look at the data, I realized that after the June fall, for the July and August, the state capex was actually up 12%. So at least that's a good sign that the states have started spending the money from the quarter of September. For the central government, I think it will be more backdated. But clearly, if you look at the data, we realize that since the pandemic, a lot of heavy lifting in the investment cycle was done by the government. And there was a double-digit growth in central government's capex spending, which clearly looks challenging this year. So yes, there could be more downside risk to a 6.8% GDP growth, what we are forecasting for this year.
Okay, Tanvee, so good having you on the show today for that quick chat. Good to speak with you as always.
Thank you.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.